Hi everyone. Welcome to a new chapter. Payroll is over with. We're going to start this new chapter. And I just want to warn you, it is not really easy. Just like everything in accounting, I wish I could be there to teach it to you face to face. So advance warning, if you're confused, read the book. If the book isn't helping you, then email me and we can Zoom conference. Okay, so this chapter is about if you were running a business and you have a business where you are selling things like a small business. So that's why it's called Sales and Cash Receipts in a Perpetual Inventory System. Okay. Oh, there we go. Okay, we'll skip that. So we're going to learn how to, we're going to learn about sales, sales discounts, sales returns, and allowances in a perpetual inventory system. So perpetual inventory system is a big word for just basically saying that inventory is the merchandise you have in your business that you sell. So let's say you have a feed store, you sell feed. If you have a veterinary pharmaceutical business, you sell livestock drugs and supplies. So perpetual inventory means that we just constantly keep inventory. And the way you do that, of course, you're all familiar with it, is that is what the barcoding system does. So when you go to Target and they scan your merchandise, or Walmart when you leave, that is the perpetual inventory system. So we don't have to go and actually manually count items. It's done basically, on the computer. Every time something is taken off the shelf, it's noted. So that's what perpetual inventory means. So two important things here, and you have to listen to every word. You really got to pay attention to this. So the first thing is merchandise inventory. Merchandise inventory are things you're bringing into your store to sell. So if you're a feed store, you're bringing in feed, clothing, farm inventory, supplies, and things like that. Merchandise inventory is an asset. Once you buy it, it's yours, it's worth money. So remember that. Cost of goods sold is always going to be debited. So you remember it as a debit, kind of acts like an expense. So cost of goods sold is what your feed cost you. You're going to buy it from the feed mill if you're a feed store, and then you're going to resell it for a higher price. The cost of goods sold is like the expense, like how much did you have to pay for that when you purchased it. Okay, so let's look at this idea of gross profit. You're going to need to remember this. It's very much common sense. So if we take, we want to know Walmart's profit from sales, their gross profit. We would have to take their sales revenue. Every single one of you have made it this far in accounting. You should know what a revenue account is. That's money coming into your business. And then if we're just looking at your profit on sales, we will have to subtract out the cost of the goods sold. So all the revenue that's coming in minus how much did that inventory cost you, cost of goods sold, equals gross profit. Okay, so I'm not going to spend too much time on this, but it's a good thing because it really does show you how a business would work. So if Walmart sells a television for $500 and the cost of that TV was $300, revenue is $500, cost of goods sold is $300, so your gross profit would be $200. So that would be a gross profit on sales. So that's what we just thought about right here. Your gross profit comes before operating expenses. Your operating expenses is the cost of electricity to keep the building running. Other operating expenses you're already familiar with would be your wages and salaries, things like that. So operating expenses decrease your gross profit. And if we take those out, then we end up getting your net income of your business. So your gross profit from sales less your operating expenses equals your net income or your net loss. Okay, so let's start with this idea of recording some merchandise transactions. So you have to remember you are the buyer. So you are, we'll just say you are the feed store or the Walmart. So you have to purchase inventory to resell. So if you bought, the example is a flat screen TV or bought flat screen TVs from Sony for $7,000 on account. So if you're buying that on account, then that would be an account payable, right? Because you didn't pay cash for it. The terms are 2/10 and 30. What that means is you get a 2% discount if you pay the $7,000 within 10 days. 2/10, 2% in 10 days. The net is due in 30 days. So if you don't take the discount, then the whole amount is due in 30 days. Remember, that's an account payable, due in 30 days. So how would we journalize that? Let me get rid of me here. You would, merchandise inventory acts like an asset, and then you now have an account payable with Sony, who you bought all the TVs from. So that's how you would journalize that. Very simple. This is just added information. So we have not paid for it yet. We just have the merchandise on an account. Okay, so let's go to the next one. Oops. Okay, so just remember, just quick reminder, that when you buy merchandise inventory, it's items that you're going to resell. Don't forget the companies, and they're going to try to trick you doing this, so you got to pay attention. Companies will have, I have to move me somewhere, I'm not in the way. Companies will have to purchase supplies, equipment, just like our regular business transactions we've already studied. So if you buy supplies and you buy it on account, or you buy equipment, you buy it on account, it's just going to be journalized just the way we've learned it all along. So that part for this chapter is a little bit of a review, which is a good thing because your final's coming up. Okay, so now we're going to give you another example of a type of journal entry. So far we did merchandise inventory and an account payable. The next thing they're going to show you is what happens if you buy your merchandise from Sony and you notice that one of the televisions was damaged. So you would do what's called a debit memorandum. It's called a debit memorandum because you debit your accounts payable, because you don't have to pay for that TV if it's broken. You bought $7,000 worth of TVs. One TV is worth $600. You debit that because you're not going to have to pay for it. And you have to credit your merchandise inventory because you're not going to sell it either. Okay? Very simple, very important. You're going to encounter that in your homework. So that is when it is a purchase, return, and allowance. So you bought it from Sony. It's broken. Sony has to give you a debit memorandum, debits your accounts payable, so you owe less, and credit your merchandise inventory because you're not going to have that to sell. Okay? Okay, here's that purchase discount. Going through this kind of fast, so you're going to have to look in the book and pay close attention to this because it's a little confusing. So what happens is this is going back to that 2/10 and 30. So what happens is a company like Sony, they want their money. And the way they encourage the Walmarts of the world to pay sooner is to give them a discount if they pay early. And paying early means before the 30 days. So that's what we have. We have a 2% discount on our bill of $7,000. But we have one TV we had to return, so we don't have $7,000 worth of merchandise anymore. We have $6,400. So if we do that, we take a 2% discount. That would be $128. So it's 2% of the amount you owe, which is $6,400. So when you go to pay Sony, you're a Walmart, you're going to pay Sony for the TVs, you don't pay the whole amount. You pay the amount less the 2% discount, but we have to keep the 2% discount journalized. So the way that we do that is your cash is going to be credited because that is how much you have to pay Sony, but we're taking that 2% discount. And we take that off of merchandise inventory. So our merchandise inventory, an asset, is going to be decreased by that credit, which it is. The value of it is decreased because we took that 2% discount. So the liability here comes in with what we bought on credit. We had to subtract out, in the previous slide, we had to subtract out the merchandise that we are not going to keep. So it's minus the $600 return. So that liability is erased. It is gone now. We don't have that liability anymore. We have $6,272 less cash, and we took this 2% discount. Okay, they're very, very important for businesses because I don't know about you, but to me, $120 to Walmart probably not, but to me, $128 is a lot of money. So if I'm able to pay it early, I'm going to make a savings in my business. And that is how you make money in business, is by saving money on your end. Okay, so sometimes what happens in businesses is you may be responsible for trucking costs or cost of freight. So, and you have to remember this because we're going to see something a little bit different. Remember, it's you buying from Walmart or you buying from Sony. So if you are responsible for the cost of freight, then it is added to the cost of merchandise. It basically makes your merchandise more expensive. So remember, merchandise is an asset. It's all the things that you're selling. It's those TVs. So those TVs now are worth more because we had to pay freight on them, if you want to think of it that way. So merchandise inventory is going to go up by $300, and you're going to pay for the freight. So you're paying for it. It's separate. It's paid to the freight company. It's not really part of your business with Sony. What you did is hire a trucking firm to bring you the merchandise. So the merchandise has to go up in value because you had to pay that, but your cash is going to decrease because you had to pay for that product to be shipped. Okay, so remember that one. Okay, now we're going to do a little bit of selling to a person who, actual customer. So, so it says sales revenues are earned when the goods are transferred to the buyer. Remember, always, we have always said this from the beginning of accounting, that when you use the revenue account, it's a credit, and there's two ways people can pay for things. They can pay cash, or they can pay for it on account payable, and that's what they mean by or credit. So that's account payable. So as soon as you, the Walmart, start selling those televisions, consumers can buy them either for cash or on account payable. So it says, keep in mind when using the perpetual inventory system, at the time of the earned sale, the seller has to do the following. The first thing you have to do is record the sales. So basically what they're telling you is it's 2 transactions in the journal. So you record the sales, and that's either going to be, revenue, is going to be your credit, and then you're receiving the cash because you're selling something, or you're receiving an account receivable. So this is going to be your debit. So debit and credit, step 1. Step 2, you have to record the cost of goods sold, how much do those goods cost you, and your decrease in inventory. Okay, so let's take a look and see what that looks like. Okay, so here we go. If I'm not in the way too much here. Says the following is an example of the sale of a TV. So you bought the TVs from Sony for $600. You're marking them up and you're selling them for $950. And you sold it on credit, so an account receivable. It's you who are selling it, so you have the account receivable. Customer Jones owes you $950, and that TV cost you $600. Okay? So here's what we're looking at. So accounts receivable for Mr. Jones, he owes you $950, and your sales revenue is going to go up by $950. Cost of goods sold, that's like an expense. That TV cost you $600, and now we have to decrease our merchandise because we no longer have that TV. So our merchandise inventory is going to decrease. Okay, so 2 transactions when we sell 1 item. Good thing we have computers, keeps track of it really fast. But that's the idea. So this goes to the customer, and this goes to the inventory, okay, and your gross profit, right? Because revenue minus cost of goods sold is going to be your gross profit. Okay, so now we get into a little bit of a tricky thing. So this is, you have to remember what we're doing here now. Now we are dealing with a customer. It's not you that got the broken TV. You are Walmart. It's not you. It is your customer who got a broken TV. So the TV is broken. The customer brings it back. What has to happen? You now understand why there's a whole department for sales returns. So we're going to introduce a new account, and that account is called Sales, Returns, and Allowances. Just remember that, this 3 words right here, Sales, Returns, and Allowances. Oh gosh, I am almost out of time. Okay, hold that thought. We'll talk about that a little bit later. Okay, I gotta go. I'm out of time. Alrighty, goodbye.